Hello everyone, I'm Kishore. Welcome to our brand new series, Commodities Decoded, where we decode every aspect of commodity markets and how it impacts your everyday life. Let's start with gold. 2024 broke every rule which gold follows. Gold soared while the dollar was strong, while real yields were positive, while the Fed was hawkish. None of that should have happened. Every textbook said gold should be falling. Instead, it exploded. Something is shifting. Central banks are buying gold at a pace we haven't seen in 50 years. Countries are systematically, quietly, deliberately moving away from the dollar. The most people have no idea what's coming. Today, I'm going to show you why gold isn't a fear trade. It's a confidence signal. And right now, it's screaming that confidence in the existing monetary system is collapsing. Let's go. Everyone gets gold wrong. The story is always crisis happens, people panic, gold goes up. That's backwards. Gold is a confidence barometer. It measures trust in the monetary system, in dollar hegemony, and in the architecture that governed global finance for 50 years. When a central bank buys gold, they are not panicking. They are making a strategic decision that says, we don't fully trust this system anymore. We need alternatives. And they are buying like never before. 2022 seen over 1,000 tons of gold bought by central banks. 2023, another 1,000 tons. 2024 followed by another 1,000 plus tons, and the highest level in half a century. 2025 has been a bit of slowdown, roughly around 900 tons. But look who is buying. China, 100 to 200 tons every year, probably more also. Russia, even under crushing sanctions, they are buying gold. Turkey literally doubled its reserves in 5 years. India, Poland, Singapore, everyone is doing it. India's gold reserves now crossed $100 billion. Look at the pattern. These aren't small players. These are major economies with complicated relationships with the US financial system. They are voting with their reserves. They are diversifying away from dollar dependence. Not because the dollar is collapsing tomorrow, but because they have lost confidence in a system where one country controls the reserve currency and it can weaponize it. Every ton they buy is a vote of no confidence. This is confidence erosion in real time, and it is accelerating. Here's what it should have happened. When real rates rose in 2023 and 2024, gold should have fallen. That's what the textbook says. Gold pays no yield or dividend. So when bonds pay 2% real interest, why hold gold? Except gold rallied anyway. The model shattered. Why? Liquidity. Real rates measure opportunity cost, but liquidity measures the supply of money, flooding the system. And in 2023, while the Fed tightened, global liquidity stayed ample. Japan defended yield curve control, China injected liquidity, and Europe stayed loose. Real rates pulled gold down, but liquidity pushed it up. Liquidity won. Here's the rule. When real rates and liquidity conflict, liquidity wins. In 2020, proved it. Rates collapsed and liquidity exploded. Gold went parabolic. In 2022, proved it again. Rates spiked, liquidity died. Gold crashed. Right now, liquidity is winning again. Watch the Fed's balance sheet, global money supply, and central bank operations. That's your indicator. When liquidity and falling real rates align, gold will explode. There's a lot of talk about de-dollarization. De-dollarization doesn't mean abandoning dollar and adopting gold. It means slowly and gradually reducing dependency on dollar and diversifying into the other assets like gold. Let's stop talking in vague terms. Let's do the math. Because when you run the numbers, the implications are staggering. Global FX reserves approximately are around $12.3 trillion, apart from the gold which is already there, and roughly around 60% of that is in dollars. So roughly it's around $7 trillion. Now imagine countries shifting 10% of those reserves into gold. Just not abandoning gold dollar, but just shifting or diversifying 10% of those reserves into gold. That's roughly around $1.23 trillion. At around $4,500 per ounce, $1.23 trillion buys you 8,500 tons of gold. So just to put it in the context, global mine production is around 3,600 tons and per year, and the total supply including recycling gold is around 4,800 tons. All central bank gold ever accumulated by all the central banks is approximately around 37,000 tons. So a shift of 10% requires 8,500 tons, which is approximately 2.4 years of total mine output, or close to around 1.8 years of total supply, or 23% of all central bank holdings in the history. It's massive. This won't happen overnight. Say it takes it around 7 years to shift 10% of reserves. That's approximately around 1,215 tons every year of new sovereign demand, which is 25% of global supply. Or if we assume that it takes 10 years, again it's around 850 tons a year, which is approximately around 18% of the supply. Either way, it is enormous. And here's the problem. Gold supply is not elastic. You can't just make more gold even if you want it. Mines take around 10 to 15 years to build. Grades are declining. New discoveries are rare. And mind you, there has not been a major find in the last 15 years. So when price insensitive buyers like central banks, which don't care about quarterly returns, try to absorb 18 to 25% of global supply, there is only one way the market clears. The price will go up and it becomes reflexive. As price raises, tonnage required will fall. At $4,500, you need approximately 8,500 tons. At $8,000, you need 4,800 tons. And the same at $12,000, you need around 3,200 tons. Higher prices will unlock new supplies, recycling will accelerate, ETF holders will sell, jewelry demand will drop, so the market will rebalance on its own, but at a much higher price. This is not speculation, this is flow mechanics. If a credible 10% reserve shift begins, and evidence says it has, gold can't stay here. Based purely on supply stress, slow 10-year shift will take it to $6,000 to $8,000. If we assume a slightly faster 7-year shift, it will take it to $8,000 to $12,000 per ounce. And if there is any disorderly geopolitical shock, it will take even beyond $12,000. These are not targets, they are what the math demands. Can gold replace the dollar fully? No. Dollars are digital, instant and scalable. Gold is physical, slow and limited. You can't email gold bars, but gold doesn't need to replace the dollar. It just needs to go from 15% of the reserves to around 25 to 30%. That's a doubling or tripling from here, and it's already happening. Gold doesn't act the same in every crisis. In 2008 liquidity crisis, gold fell initially as everyone sold everything, everyone needed cash, so they sold everything. But 6 months later, once central banks responded with quantitative easing, gold exploded to around $1,900. Same thing in 2020 when the COVID hit. Gold rallied immediately because the policy response was instant. Rate cuts, quantitative easing, stimulus. Gold didn't wait for liquidity, it anticipated it. In 2022, inflation shock. Gold was choppy because inflation is bullish, but Fed tightening is bearish. They fought each other all year long. Gold struggles in liquidity crisis until banks respond. Then it explodes. Gold thrives when the fix is printing money. Gold chops when central banks tighten. Ask yourself, is the fix more money or less? That tells you where gold goes. If you are an investor, what does this mean? The old wisdom says 5 to 10% of your portfolio should be in gold. That's outdated. In this environment, in the monetary instability, geopolitical fragmentation, and active central bank diversification, 10 to 15% makes sense, maybe more if you are worried more about the systematic risk. How you hold, that also matters. Physical gold is the true ownership of gold. Though there's no counterparty risk, the storage costs and the liquidity challenges are there, but it's absolutely safe. Gold ETFs is a very digital and the modern way of investing in gold. They are very liquid, convenient, tradable, but you want to claim it's a paper but not the metal, but still it's extremely safe. You can also buy some stocks in gold mining companies but that also comes with leverage. When gold rises 10%, the mining stocks might rise 30% also, but it comes with operational risks, political risks, and execution risks. Most people should blend physical for security, ETFs for liquidity, and maybe small mining stocks, or maybe even some futures and options positions on MCX for your short-term trading purposes. But if you want to time this market, watch real rates and global liquidity. When both favor gold, rates falling, liquidity rising, that's when it moves. When they conflict, it chops. When both are against it, stay away. So watch geopolitics. When reserves get frozen, like Russia's $300 billion, other countries notice. They realize their reserves are not safe. That accelerates de-dollarization, and that's the rocket fuel for gold. Gold is not just metal. It's a signal. It's a real-time barometer of confidence in the system. And right now, it's showing panic. Central banks are buying at the fastest pace in 50 years. De-dollarization is not a headline anymore. It's a clear math. The supply-demand mechanics are inescapable. If a credible 10% reserve shift begins, gold can't stay at current 4,500 levels. It might even cross 8,000, 10,000, or even maybe higher. This is not a trade. This is a regime shift. Gold is moving from a tactical safe haven to a strategic reserve anchor. So we are at the beginning of something big. So position accordingly and stay long in gold. In our next episode, we will cover silver, gold's volatile cousin that moves twice as fast and half as predictable. We'll decode the gold-silver ratio, the renewable energy hype, and whether this rally is real or another trap. I'm Kishore. Stay sharp. See you next time.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.